There's a new IPO on the Hong Kong market that's got a lot of people talking, Bao Pharma. The question on everyone's mind is, should you put your money in? Well, today, we're going to cut right through the hype and give you the real data-driven analysis you need to make a smart call. So let's frame this up. What are we really looking at with Bao Pharma? Is this the next big breakout star in the biotech space? Or are there some hidden risks buried in the fine print that could make this a financial trap? That's what we're here to find out. All right, here's our game plan. We're going to put Bao Pharma through what we call our analyst's gauntlet. First, we'll look at the story they're telling investors. Then, we'll dig into the numbers for any red flags. We'll map out who's really in charge, explain the unique rules of the Hong Kong IPO game, and finally, I'll give you my final verdict and our subscription strategy. Let's get into it. Okay, first up, the promise. You know, every company going public has a story, a really appealing narrative to get investors excited. So let's break down what makes Bao Pharma look so good on the surface. So what do they actually do? Well, the best way to think about Bao Pharma is like an assembly line chef. See, they aren't in the high-risk game of inventing brand new drugs from scratch. Instead, they take proven recipes from other pharma companies and just get really, really good at making them. It's a business model all about efficiency and scale, which can be a lot less risky. And the heart of their promise really comes down to three key drugs. You've got KJ117, which is a total game changer for patients, turning IV drips into a simple shot. Then there's KJ103, a first-of-its-kind enzyme with literally no competition right now. And finally, SJ02, a fertility drug that's going after a $250 million market. You can see why people are excited. The story is definitely good. I mean, it's compelling. But a good story, well, it's only half the battle. Now we have to ask the tough question. Do the numbers actually back it up? This is where we pivot from the promise to the proof. And boom, right away we hit a potential red flag. Take a look at this gap. Over the last 3 years, Bao Pharma reported about 500 million RMB in net profit. Looks great, right? But the actual cash that came through the door from operations was only 300 million. That's a 200 million RMB difference. It means that while the company looks profitable on paper, a huge chunk of that money isn't actually in their bank account. So where did that cash go? This chart tells a big part of the story. This shows accounts receivable days, basically how long it takes for a company to get paid after they sell something. As you can see, Bao Pharma is waiting over 150 days. That's way longer than the industry average. So all that cash is just stuck, waiting to be collected from customers. That's a cash flow problem. Now, this might be the single biggest risk, and it's pulled straight from their own documents. Over 70% of their sales depend on being on the government's medical insurance list. Think about that. If the government decides to remove one of their key drugs from that list or slash the price, a huge piece of their revenue could just disappear. That is some serious concentration risk. Okay, so we've looked at the financial risks, but what about the human element? Who is actually in control here? It's absolutely crucial to figure out if this company is set up to work for all shareholders or just for a select few. And the power map here is crystal clear. It's a textbook family-controlled company. The founder has a holding company. That company owns the majority of Bausch Pharma, and the bottom line is that the founder's family controls over 55% of the votes. That's ironclad control. They can make any decision they want. And that control goes all the way to the boardroom. Just look at this breakdown. You've got 6 board seats filled by insiders. That's the family and their team. And only 3 seats for independent directors. That's a 2-to-1 majority. So you have to ask yourself, can those 3 independent directors really challenge the insiders if something goes wrong? It's a tough spot to be in. And here's where that control gets really concerning. Bao Pharma buys about 200 million RMB worth of materials every year from another company, a company that happens to be controlled by the very same founder. And look at the price. They pay market rate plus 5%. This is a massive conflict of interest. It basically creates a pipeline to potentially move money out of the public company and into the founder's private pockets. So we have the company risks pretty well defined. But before we get to a final verdict, we need to do a quick crash course on the Hong Kong IPO market itself. Trust me, you need to understand these rules to play the game effectively. First up is something called the clawback mechanism. This is actually a fantastic rule for us small retail investors. Basically, if an IPO gets super popular with the public, The exchange forces the big investment funds to give up some of their shares, which then get clawed back and given to us. So the hotter the deal, the more shares you might actually get allocated. Next, you gotta know about Group A and Group B. All retail applications are split into two buckets. Group A is for smaller subscriptions, and Group B is for the big ones, over 5 million Hong Kong dollars. They get shares from totally separate pools, which means they aren't competing with each other. It's a strategic thing to keep in mind. And finally, there's the gray market. This is kind of cool. It's unofficial trading that happens for a few hours the day before the stock officially lists. Now, it's not the real market, but it's a super valuable early signal. It gives you a pretty good idea of the early demand and what might happen on day one. Okay, we have analyzed the story, we have stress tested the financials, we've mapped out the power structure, and now we understand the rules of the game. It is time to put it all together and get to the bottom line, our final verdict and subscription strategy. First, just the key facts. Subscription closes on December 5th, and it lists on the 10th. Your entry cost is a little over 2,600 Hong Kong dollars. But here's something really important to notice. There is no green shoe option. That means the bankers don't have a stash of extra shares to support the price if it starts to drop. So that could mean a bit more volatility right after it lists. So after weighing everything, the exciting drug pipeline against those pretty serious financial and governance risks, here is our final rating. We are giving Pharma a very, very strong 4.5 out of 5 stars. And just for context, there's another IPO happening at the same time, JD Industrials, and we're only rating that one at 3.5 stars. Now, because the subscription windows for these two IPOs overlap, you're probably going to have to choose where to put your money. For us, the recommendation is clear. We say you should focus your capital on subscribing to Pharma and just skip JD Industrials. The potential reward here just looks a lot better. So, there you have it. That's our call for the IPO itself. But it leaves us with the big, long-term question, doesn't it? Is Pharma's incredibly promising drug pipeline powerful enough to eventually overcome the very real governance risks we've laid out? That's the billion-dollar question that will define this company's future. Thanks for tuning in.